the owner of LFG Lending. We started this brokerage about a year and a half ago, so we're a little bit newer, but we're growing very quickly, and the expectation is to continue growing pretty aggressively because we are a national brokerage, so we can lend nearly nationally. There's a couple states that we can't, like Nevada, the Dakotas, Vermont. Not that a ton of you guys are investing in those areas naturally, but again, nearly nationally, we can service your lending needs. From there, we have loan officers here in Ohio, and also a couple loan officers in other states. And our goal is to continue to grow outside of Ohio as well into other states so that we can kind of be knowledgeable of some of the other markets that some of our investors are investing in. So any of these individuals could be working on your file at any given time, or answering some of your questions as we continue to get busier. So just know that any of these members could be helping you guys out. From there, we offer, click this here, we offer many investor products. So again, we're a brokerage that focuses solely in investment real estate. So we don't do conventional, we don't do FHA or VA, we don't do your second home financing or your primary loan financing. We're solely focused in any investment purchase that you're planning on taking down. And then conveniently, all of our products are focused on making the loan process as easy as possible for our investors. So we do everything from DSCR loans, which we'll go into more detail, but that is a debt service coverage ratio loan. We do Airbnb financing, so loans that are based off of potentially projected Airbnb income. We do commercial financing, and that doesn't mean that the property has to be zoned commercial. We'll get into some detail about that as well. I would say a lot of our investors are taking advantage of those products. We do bridge loans. Heaven forbid your rehab is to take longer than expected. We could always refinance you out of your hard money loan into something like this. We do hard money loans, fix and flip, fix and hold, all the same loan, different terminology, but again, same exact loan, same exact structure. And then last but not least is new construction, which we're starting to see more and more of as we're still in that shortage of inventory in the market across the nation. People and especially investors are starting to consider new construction opportunities as something to consider. So we'll go through each one of these in some detail. And again, feel free to raise your hand if you have any questions. From there, we actually had this presentation scooped up for agents. So if you are an agent in your area, feel free to get in touch with me. We would love to service your area as well, just like we kind of help Mitch with his clients. But what this does allow you to do is investors, agents that are in this space just tend to have more transactions. And so that definitely allows for us to service you as you grow your portfolio and vice versa. Wrong direction. From there, I would say the easiest thing that most of our investors are doing is the BRRRR method. So most of you guys are probably fairly familiar with this. This is buying a property, rehabbing it, renting it, refinancing, and repeating that process over and over again. This is, in my opinion, I occasionally get some phone calls where people are like, where should I start? And I typically say start here because I think it is the most strategic way to utilize your cash and really grow your rental portfolio to a next level. Again, on an individual basis, we'd love to sit down and kind of take that step one by one. We will go over some of the loan products that you use to achieve this. But if anyone wants any more detail, just kind of a slower walkthrough of how this works, we'd love to set up that appointment with you. From there, the first step of a BRRRR is buying the property. And I would say most of our clients, though, some of you may have the cash position to buy the property in cash. I would say what we're seeing a lot of is individuals that are buying in cash tend to lose out on opportunities in the future where a lot of their cash is in one property and it limits them from buying a second or a third or a fourth at the same time as your property is getting rehabbed and then rented and refinanced. So a strategic way to use your cash is to consider hard money loans. So hard money is a short-term loan product with rehab included. So they're typically 12-month loans, interest-only payments, and the structure of it is based off of the, I would say, after repaired value. So I typically use the analogy of if you have a $100,000 ARV, not that those things are easy to come by, especially in this market, but just to make the math easy for me this evening, if we had $100,000 ARV, you're going to want the total cost of your project to be at 75% of that. So no more than $75,000. And that includes the purchase price and the rehab. Now that's the perfect scenario. It's not that you couldn't consider deals at 80% or 85%, but you're likely going to keep more money in the deal if you decide to keep it as a rental, or if you're flipping it, it's going to eat into those margins, but still something to consider. We can go down to credit scores down to 620. Probably go a little bit lower than that, but I would definitely say that you would need to be in a liquidity or an asset position to kind of offset that credit score being as low as it is. We do have options for someone with no experience in the investment space. So you don't have to have owned an investment property before. You don't have to have flipped a property before. None of that is of concern. I would say one thing that is typically required with most of our lenders, not all, is that you own your primary residence or have owned your primary residence in the past. Let's say that's something that you haven't done. We definitely have lenders who are flexible, but let's have that conversation separately, as the terms could be a little bit more expensive. Rates are driven by experience. So though you can have no experience, as you grow your experience, your terms and conditions are only going to get better. Your down payments are going to get lower. Your rates are going to get lower. Origination costs may be a little bit less. So this is a perfect product to use to, again, take down the property, get it renovated. And then in our 2 slides from this, we'll discuss how you refinance if you decide you want to keep this as a rental. So any questions about hard money? Cool. Easy enough. In the hard money space, I would say rates fluctuate right around 10 to 12%, depending on experience. So kind of keep that in mind. What we'd like to do with our clients is, even if you're taking down a hard money loan, we want to try to make sure you have as many exit strategies as possible. Exit strategy is saying, I'm going to flip the property. That's one exit strategy. I'm going to keep it as a rental, or you're going to make it an Airbnb. We want to kind of exhaust as many of those options as possible so that, heaven forbid, something is to happen. Rehab budget's higher than expected. The market corrects. Life occurs, and maybe the rehab itself is taking longer than expected to complete. Stuff like that, that we have a way to transition you into different loan options to protect you as a borrower. So we try to figure that out before you even get into contract. Our goal is to ensure that you feel as confident as possible from the start of the transaction to the end of it, so that you can get to the point of continuing to repeat this process as many times as possible.
How many properties do I need to be considered to get better rates?
It's kind of humorous, to be honest. So experienced is 5. I would say that's going to give you best pricing. I always kind of laugh at that, and it's 5 over the last 3 years. So experience is a 3-year look back. And so if you had transactions that you did 4 years ago, we could potentially not be able to use that. But 5 is that sweet spot. And I always just kind of laugh, because if you've done 5 deals in the last 3 years, I don't know that I would call you an expert. But you definitely have done this enough to kind of get your feet dirty, really get the feel of it. There's a couple lenders who, if you can get your experience up into the teens, your pricing improves even more. So every lender is a little bit different. As Mitch mentioned, we work with about 40 different institutions. And the nice part about that is, if we run into any hurdles, heaven forbid that is to happen, instead of us looking at you guys and saying, I'm so sorry, I'm not able to help, what we do is say, I'm so sorry that this happened. Let's figure out a solution. And we can very quickly pick up your file, move it to another lender, and try to stay on track for closing. And that's kind of one of the many benefits of working with the brokerage. Next is the bridge loan product. Again, this is a short-term loan, very much like the hard money loan, but it does not have rehab. There's no prepayment penalty on hard money or bridge loans. And so in a lot of cases, I would say there's 2 reasons why most clients use a bridge loan. Let's say your rehab is taking longer than expected. And I would say this is on like extensive rehabs, big properties, full guts, etc. Where, as many of you may have felt, 6 months ago, we were at construction costs being much higher than expected and, having a hard time getting supplies in. So those, this product was used, I would say, a little bit more over the last 6 months, but generically speaking, is not used a ton. Second reason you could use this product is to stabilize a multifamily properties. There's going to be transactions that you may consider on multifamily properties where the rents are way less than they should be. They're under market rent. And what this product allows you to do is take a short-term loan, get those rents where they need them to be, and secure the best financing possible during your refinance. So again, we can evaluate, does it make sense to do that? Can we still get the deal done with the rents that are in place and kind of balance out what's going to make the most sense? Rates in the bridge loan space are a little bit cheaper than hard money, not dramatically, but a little bit cheaper than hard money, and they can go out as long as 24 months. So also, if it's just a property that you don't plan on having long term, this could also be something to consider. Next scenario is new construction. And again, I would say actually in like the last 3 months, we've seen a significant jump in traction in regards to investors being interested in this space. So if you decide to purchase a lot, build a new property, we can help you with that. We can also do, bigger things like development financing if that's ever of interest for you. Those are a whole nother beast. So just let me know if that's ever something that you want to kind of discuss of how those options work. We're currently working on a construction deal down in Hocking Hills that is eventually going to be used as an Airbnb. So there's definitely multiple ways for that property to be used. Now, I will say land financing, so just purchasing land by itself can be kind of difficult. So what we tend to like is to take your land financing and the construction and put it in one loan during one transaction. So, on Mitch's side, he's going to want to write a little bit longer of a contract so that we have time not only to get a contractor out there, to get the quote, to get everything finalized, but also get through the loan process. These loans tend to be a little bit longer than hard money. I would say closer to 18 months so that you have plenty of time to get this project completed. It's also interest only, so very similar to the hard money space in regards to structure and the draw process. Only difference is you're building a brand new house, so you're going to hold that property a little bit longer than you would for a hard money loan. So just kind of keep this in mind. I would say, the inventory issue has been known for, we're probably verging on like the last 3-ish years at this point. And this is a way that I think some investors are considering a way to kind of jump above that and, kind of force inventory into the market. So something to consider. You would need a little bit of experience in a perfect world, and that could be in the flipping space. It doesn't have to be actually in new construction, but let's have further discussions of if this product is appropriate for you. Next is my favorite product. So DSCR, it will hands down be the easiest loan you've ever done. There's no income validation. And actually all of our loans that I've discussed so far, including DSCR, have no income validation, no tax returns, no W-2s, no pay stubs. Hell, you could be unemployed and I would give you a 30-year fixed mortgage on a cash flowing property. So that's really our goal. If we have a cash flowing property, if we have the credit to qualify, and we have the funds to close, we give you a 30-year fixed mortgage. Huge. So DSCR, debt service coverage ratio, really what that means is, does the rent being received cover the expense of the property? So we have lenders that'll go down to 1 times DSCR. You don't know what that means. It's totally fine. 1 times DSCR means that if you have a mortgage payment of $1,000, we could qualify you for a mortgage as long as your rent is $1,000. Yes, I said that correctly. You do not have to have a cash flowing property technically. Now, some of our lenders would want a cash flowing property where they're going to want like a 1.2 times DSCR or 1.25. And so in that scenario, $1,000 mortgage payment, they're going to want your rent to be $1,250. So these lenders are not looking for this exorbitant amount of cash flow. They're pretty reasonable And so this allows for a ton of flexibility for you to pull cash out of these properties and continue to invest depending on your risk tolerance. And I would say that's the biggest thing at LFG that we try to stay really cognitive of. You know, between everybody that's on this call, not everyone's risk tolerance is the same. So a deal that I would consider and a deal that Mitch would consider and a deal that Tony would consider are going to be completely different. Maybe my risk tolerance is really low and I'm going to want my cash flow to be at least $400 a month to even consider a transaction, where Mitch is willing to go down to $200 a month because he's able to pull some cash out and buy another property. We can work with you as to where that risk tolerance is and what you're really looking to achieve. These loans do have prepayment penalties. So unlike conventional loans where there's no prepayment penalty, there are penalties if you decide to sell or refinance in a certain period of time. Now, we can be flexible with that. I would say the standard prepayment penalty is 5 years, and it's based on a step-down system, meaning that if you sell within the first year of having that loan in place, there's a 5% fee, which is ugly. So if you're really confident, and what it does is it steps down from there. So year 2, it's 4%. In year 3, it's 3%. In year 4, it's 2%, and it goes down to 1. And then after that, no penalties for having, to sell or refinance after the 5th year. We have lenders that have shorter prepayment penalties. So I would say the 3-year is pretty comfortable with most people. So it's a 3% fee if you sell in the first year, 2% in the second, 1% in the third. So it's just figuring out what makes the most sense for you, especially with your plans on the property. The biggest thing that is the big push that has happened in the DSCR space in the last 5 months is seasoning. So conventional financing, Fannie and Freddie, changed their policy in regards to seasoning from 6 months to 12 months. What's seasoning? Seasoning is the amount of time you have to wait from the date that you purchased the property to use the new appraised value. So let's go back in time. We're buying a BRRRR property and we're buying it and we're going to rehab it. And then our terms and conditions are going to be based off of the ARV or the after repaired value. So to use that ARV on a conventional loan, you would have to wait 12 months. It's way too long. To be honest, like your loan's 12 months long. So to wait that long is not really an option, especially with the holding costs that would charge you. So your next option is going to be considering DSCR or commercial terms. And then I would say in the more retail style banking, you're going to be looking at portfolio loans potentially as well, as they may have shorter seasoning. But again, nothing that's Fannie or Freddie backed or any government loans will allow you to refinance any sooner than 12 months. And again, our seasoning periods are as short as 3 months. Actually, we have one lender that is no seasoning, but that's in our commercial space, which is next. Then in our DSCR space, we have 3 months seasoning, and we have a few lenders that can help in that space. And then we have a bunch of people that can do 6 months seasoning. So just know that we can, complete your BRRRR in a faster timeline with a DSCR or a commercial loan. Again, the rates are not dramatically different from DSCR to conventional. So it's definitely something you want to consider anyway. The process is a lot more seamless. A lot of the BS that comes into a conventional loan is kind of thrown out the door in regards to DSCR financing. So again, would love to talk to you guys about that. The other added benefit is we close in an LLC, which is honestly a great protection for you. Rental properties as a whole really should be closing in an LLC to protect you from any personal liability. So this is just another added benefit that conventional financing cannot offer. Before I go any further, any questions? Cool, guys. Next is commercial. So again, I would say there's kind of two spectrums of investors that are taking advantage of commercial financing. And when I say commercial, I'm saying commercial as a loan type, not zoned, though we can help you with zone commercial. But when I'm talking about it as a loan product, it just means that it is it's done with a banking institution. So very similar to a regional or a local or a national bank that could be in your guys' city limits and through a business banker. So what we've done is we've grown relationships with certain banks that have incredible terms and conditions that can help with something as small as a single family, a 2 to 4 unit, 5+, or anything that is zoned commercial as well. So warehouses, storage units, office spaces, restaurants, anything zoned commercial, we can also help. But we can service still the single family and multifamilies in this space as well. These loans do have full income validation, so it's going to feel a lot like your conventional loan. I will say that I've been in lending for 10 years, so I know what is needed and how to request docs up front so that you're not burdened by these 1Z, 2Z requests over and over again. So again, our team tends to request a ton up front, and then we try not to bother you again until closer to the end of the process. The rates are so much better. So, and again, I don't want to speak for every city, but in Ohio, we have commercial lenders with rates as low as like 5.85 as of today. So super competitive. Those rates are actually lower than conventional. We do have commercial lenders in other states, but we are a little bit more limited in that space compared to our DSCR loans. So again, DSCR, all states except for the Dakotas, Nevada, and Vermont. Commercial, let me know where you're investing. And if we don't have a lender in place, we can definitely spend the time to get one in place. So know that as well. If we don't have a product, if we don't have one in that state, we're going to do everything in our power to kind of do that shopping for you, really vet these lenders and make sure that you're positioned in the right loan product. Again, this loan is going to be very similar to your conventional loan, but they will have more strict DSCR guidelines. So before, where on the DSCR product, I could give you a loan with no cash flow at all. It's not going to happen in the commercial space. So they're typically going to want a 1.2 times DSCR, plus they're going to want a 25% expense ratio based on the rent that's being received. So roughly, they're going to want you cash flowing in the $500 to $600 a month range. So it's really picking and choosing what deals can I send commercial. I would say our multifamily properties tend to do really well in this space. And then alternatively, we can use our DSCR products for anything that's cash flowing less than that. And that's kind of the cool thing, is we're going to be here to assist with your hard money loans and then transition you into long-term financing as well. So we're really your one-stop shop. Last but not least is our short-term rental product. Airbnb loan in short, but obviously you can use VRBO. You can just have a website yourself, however that plays out. The crazy thing is the way that they determine the DSCR calculation is based potentially off of AirDNA. So AirDNA is a website that determines projected Airbnb income. And we do have lenders that'll go off of whatever's said on that website as a projection for the property. I would say, sometimes those numbers tend to be a little bit low. Sometimes they are very exorbitant. But in a lot of cases, no matter which way it kind of falls, it does allow us to qualify for, most lending needs that someone would have. This also allows us to qualify you for properties that are in rural spaces. So let's kind of backpedal. DSCR, they love rural. We have one lender that'll do rural properties, and rural is a little bit subjective. We actually have a website that we can check a property. So if you're unsure and you want to clarify before making an offer, shoot it over to me via text, send me an email. We'll toss it into the system and get confirmation before we get too far into the process. Commercial, they don't care about rural. They're totally fine with that as long as it's a good property. Short-term rental, again, they're comfortable with that because in a lot of cases, Airbnbs are in more rural areas, cabins in a mountain, those kind of things. And so they have the comfortability for that as well. Second option in regards to qualifying for an Airbnb loan is they'll do what's called a 1007 analysis based off of short-term rents. 1007 is an appraisal report that determines market rent. And instead of going off of long-term rents, they'll go off of short-term rents. And so this is an additional way to qualify for a property. So again, keep this in the back of your pocket. We can use DSCR or commercial to make these deals work, and we're still closing in an LLC. Again, we are here to be versed in as much as possible in the lending space and really guide you through this property into future properties in the future. Our goal is to continue growing generational wealth for you and your family, and hopefully friends as well. So please, we'd love the opportunity to set up individual meetings with each one of you and really get into the weeds of kind of how we can continue to help you personally. Any questions? Perfect, guys. Well, I appreciate the opportunity speaking with you guys. Would love, again, feel free to grab my information from Mitch. I think we also, do we have a screen on here that has it? JK, just thank you. I will make sure that I get your information from Mitch. Just send a quick email so you guys have our contact information, and also our Calendly link, which is a perfect way to set an appointment without us kind of going back and forth on times that are available. So please don't hesitate to reach out. We're so excited to work with you guys.
Thank you so much, Liz.
Perfect. Have a great night,
Yes.
guys.
See ya. All right. Anybody else want to talk about real estate related stuff? Totally down. We got 15 minutes left.
I may have a question.
All right. What's up, Kevin?
On that last slide she had for the Airbnb loan, one of their bullet points said higher rates but more cash flow. It seems contradictory. Any idea how that works?
I have not done an Airbnb loan with Liz yet.
Okay.
I think she has a couple Airbnb properties herself. But what I took from that though was the rates are higher because of the volatility of an Airbnb, but because it's an Airbnb, your cash flow should be higher. So
I got you. Okay.
You're really going to have to believe in your numbers as far as what you think.
Yeah.
The property's going to cash flow for, but your rates are going to be, obviously slightly higher. So, and we're refinancing people into DSCRs at like 8.5% to 7.5% right now. Depending on credit score, you can get maybe down to a 7, something like that. But the products that most of our clients are using here in Cincinnati are hard money refinanced into DSCR. You probably got that from her presentation. Those are her favorite things. So,
Gotcha.
But yeah, what other questions you guys have? I'm here to talk about anything real estate. It doesn't even have to be financing anymore.
I guess I got one.
Oh, Sean's got one.
So kind of how is like the Airbnb market in Cincinnati? Like, is it something you see often? Is it centralized just around certain areas?
Cincinnati got voted like one of the top areas in the country to do Airbnbs. And it's not because of your typical, oh, this is what an Airbnb is, right? It's a vacation rental. No, it's a corporate rental is kind of what Cincinnati is known for, because we have so many Fortune 500 companies here. When people travel for work and stuff like that, a lot of these, 9-to-5 corporate people or whatever are who is renting out these Airbnbs. With the kind of second half of your question, it is very, very localized. My short-term rental Airbnb manager has like a 5-mile radius around, basically put it in the middle of the Ohio River. He goes to Newport, Kentucky, along the river and stuff there, downtown Cincinnati, OTR, Mount Adams, which is also like right downtown, and that's it. Like he will not go anywhere else for short-term rentals. I see a lot of need for short-term rentals up in like Hamilton, Ohio, with the Spooky Nook opening up, the convention center and everything kind of going on there. It's just harder to find an Airbnb property manager. So my normal property manager for Airbnbs charges about 15% of gross monthly rents to manage your property. Up in Hamilton, it's anywhere from 25 to 35% of gross monthly rents. It's ridiculous because nobody wants to go up to Hamilton. So it's a bit tough up there. So it is very, very, very localized.
Okay, cool. Thank you.
So, but not impossible.
Yeah.
When they talk about short-term rentals, what are they usually considering? Because I know some people do like when it gets to like 4 or 5, 6 months, it's more like midterm rentals, or is that still considered short-term for this conversation? Or
Right. I don't exactly know what the cutoff line is. I know what the IRS determines as a short-term rental is anything with an average stay of less than, I believe it's like 4 days or something like that as a short-term rental. For me, I don't distinguish. I call them all furnished rentals because when we market our Airbnbs, we market them as you can stay here for a day or a night, or you can stay here for 6 months. I really don't care, right? You're going to pay basically the same rate, right? I'm going to have it cross-marketed on like Furnish Finder and Airbnb and VRBO, right? All the different sites where if you want to book it for a night, that's great. You want to book it for 6 months or 9 months or 8 months, less than a year is typically what it is. That's also totally fine with me. So I refer to them as all furnished rentals because that's the only difference between that and the long term. I don't know what Liz's criteria is. I would assume that it doesn't really change. If it's a short term rental, if it's marketed on Airbnb, if you're marketing it furnished, Airbnb rental financing would work for midterm rentals as well. But
looking at different areas,
Mhm.
like I just checked out, I think it was Coleraine about a year ago or so, just a curiosity on the short-term rentals and stuff. And I know they have limitations in that you can do short-term rentals, but then anything after, I don't remember what it was. It was like 30 days, you're not allowed to, but if it's over a year, you're allowed to. And they had this really weird, like that's why I asked about midterm, because some of the areas I'm finding have these really weird, quirky rules about midterm rentals.
Yeah, and I haven't seen that so much with various specific areas and townships and cities and stuff like that. But the wording that you're explaining, I see a lot in condo HOA documents. I don't know if you were looking at condos or not, but I see it a lot in HOA for sure.
This was just for the, one of the neighbors was saying that I guess you have to get a permit to be in a short-term rental in Coleraine, or in what is it? It's a Pleasant Run, which is, well, they fall under Coleraine. And so then when I was talking to them, they're like, oh yeah, you're not allowed to have midterm rentals, but you can have long-term and short-term. And I thought it was like, all right, that's just weird. And they're like, well, we don't want boarding houses. I was like,
yeah, I get that. Yeah, like I used to live in Fairfield, which is like literally right up the street from there, different county and everything. And they're like a big giant HOA. I know that they have similar type rules up there and they're very picky about stuff. To me, it's kind of surprising to me that they even have those rules, because to me, I don't know why you'd want to have a short-term rental Airbnb, midterm rental in like Coleraine Township type area. That's not like a hot area for me. If I remember right, that's where you currently live, right?
yeah.
Okay, so you're talking about almost turning the house that you live into a midterm rental, short-term rental type deal, right?
Yeah, I looked at doing that for like nurses and similar occupations.
Okay, gotcha.
I did Airbnb for several years and it was exhausting. Every other day you're changing sheets and completely deep cleaning everything and stuff. And I wanted something more like, hey, I'm going to clean it when you come in and I'll clean it when you go out, but you can take the shift in between.
Yeah, absolutely. That's why I really, really like the longer term furnished rental, right? And we're doing a lot of those in like the Evanston type area, like Walnut Hills, Evanston, because you're really, really, really close to all the hospitals down there, but you don't have to be in Avondale. which is right next to the hospitals, but a lot of it is terrifying, right? And it's a lot of young professionals, nurses, all that kind of stuff who are renting these things. And I would imagine you might have a tough time doing a furnished rental type deal that far up in Colerain Township, Pleasant Ridge type area, because I feel like we're just, that's kind of close to like Mercy Hospital, I guess. But there's, I'm trying to even think what else is up there.
Yeah, I thought about converting my house into a rental and then either renting myself at a smaller property or buying a second property or something like that. But I don't know how to do as a rental either.
Yeah. So your best comp is going to be my house in Fairfield. We had it rented out as a rental back in 21. Yeah, 2021, kind of into early 2022. It was a 4-bedroom, 2.5 bathroom, 3,000 square foot redone house or whatever. We got $2,000 a month for it. And we ended up suing those tenants for $30,000.
Right.
They absolutely destroyed it. So, and you are right down the street basically from there. Depending on the size of your house. I remember us talking a little bit.
Thank you for the hope. No.
Yeah, right. I know it's not right. For me, right after that experience, I said, I'm never buying a property that's nice enough that I would live there and renting it out, period, ever again. Because
I've heard other people say the other way to them, like if you're going to do a small time, you don't buy a property that you wouldn't want to live in.
Well, they must have lower standards than I do, which could very, very be true. But the finishes and stuff that we had in that house, I mean, the reason we ended up getting like $15,000 from them, and thank God we own the construction company because that's what it costs. But we also got a $9,000 lawyer bill, and just the nice tile floors and we don't put in super nice finishes in rentals, right? Unless it is going to be more of a furnished rental type deal, it needs to look nicer. But those people, they're not there long enough to do enough damage, honestly. It was tough, like renting out a house that was that nice, and then you get all the crazy looks from all the neighbors and stuff like that because they know that your house is a rental now. It was an experience that I don't want to deal with ever again. So I know that gives a lot of hope, but that's my personal story in renting out like really nice single family houses. But, so it's tough, right? If you're going to do something, if you're going to keep it as a rental or something like that, definitely. I mean, we vetted our tenants super well. They had great credit scores and everything. They were actually students, like grad students up at Oxford, but apparently they had a rabbit and chicken obsession. And there was like 25 rabbits and chickens in our garage. They bred puppies, golden doodles in our house. That's why everything got destroyed, right? It's just this stuff that you can't really verify for. We walked in there one day and it was just a zoo, and it was just absolutely ridiculous. But it's tough. I would almost just like either sell your house, move someplace smaller, take a HELOC out on your house if you've got some equity and stuff like that in it. Yeah, interest rates and stuff are higher, but go use that HELOC as cash to go buy, cash flowing rental properties, or maybe eventually even something, use the HELOC on your current house to buy you another house, right? That's maybe smaller, more manageable, something like that, in a different area, wherever you want to be, right? And then go and sell your house afterwards. At least from my experience, never again will I do that nice of a single family rental. I see houses up in Westchester and Mason and stuff like that for $3,500, $4,000 a month, and I just cringe, and I'm just like, oh no, this is not going to be good. It just that's not what our clients do. I look at everything under $200,000 is what we look at for BRRRR properties and rental properties.
Is it common for property managers or owners to walk through properties on a regular basis, like every year, every 6 months or something like that?
Property managers are going to do absolutely the bare minimum that they have to. Unless there's an issue, they're not going to be there.
So like when you read like articles, Bigger Pockets and stuff like that, there's a lot of, they put a lot of weight on, not a lot of weight, but they talk a lot about walking through your property at least every year, doing a thorough check, like having a checklist of looking at all the stuff and just make sure things are in line. But then when I've talked to some people around here, they look at you like you just started speaking Chinese to them.
No, and I definitely think it's a good idea in principle. If you hire a property manager, they're not going to do that unless you specifically tell them to do that, and they're going to charge you for it, right? So I have a client here that chooses to manage his rental property from Florida. He pays us, quote unquote, as his property manager, but we are not property managers. He pays us every time I go out there. We're having to deal with an eviction process right now. So every time I go visit the property, depending on what's going on and what's happening, it's $50 to $150 every time I have to go out there, right? So you can kind of do it that way. You definitely need to be checking in on your property. You need to know what's going on. You need to make sure that, the neighbors aren't reporting them every other day for loud music and the grass that's 4 feet tall and all of that kind of stuff, right? But I mean, even a 6 month to a year basis, go there and check in on them, or tell them you have to change the furnace filter, or, general maintenance checkup, right? I have clients who ask me to go do maintenance checkups, like, hey, Mitch, will you go walk through our property? They have notice or whatever. They know you're going to come at this time, and just let me know if there's anything that needs fixed, right? They won't tell me anything. They might tell you something if you tell them you're the contractor and everything, which we are. I'm a real estate agent and a contractor. So that's kind of a workaround that a lot of people have done. You need to be visiting your property, especially if you live here. Now, I will say, let's see, most of the people on this call don't have that ability because you guys don't live in the state, right? So you kind of got to trust your property manager and stuff like that and go through it. And it's kind of just a leap of faith. But unless you tell your property manager to do it, they're not going to.
Yeah, they'll say to put it in the contract that you will be there at least once a year to do a full walkthrough. Here's a checklist. Well, they give you notice and everything, but I see it as a good idea, but I think it's a lot about being new at this makes me nervous. But,
yeah, absolutely. No, we are totally here to help you kind of walk through the process, make sure that things aren't done. We have a really great property manager that we've referred probably 200 doors to over the last couple years. I don't know if it's in her contract to go visit the properties. I will tell you, she's a lot better than the other ones that I've had, because I sold a 31 unit and a 44 unit. I've walked those properties with her a couple of times. All the tenants know her name, which could be a good thing or a bad thing, but they normally are coming up to her and talking and having a conversation. If they don't know the property manager's name, they know Stephanie, her assistant, right? They know who they are. They are aware. They know who the people are. They've had conversations and stuff with them before. That's why I really like, her name is also Liz. Different Liz though, but that's why I like her, because she does actually have rapport and everything with her tenants on her own personal properties and on the properties that I refer her to as well. But I don't know if it's written in her contract.
Yeah, well, so actually, Mitch, we have it. We just signed the contract with Liz, and it is in the contract, and there's a fee associated with it, though.
Yeah, that sounds about right. There's no money to be made in property management. It's the reason that I don't do it, right? They have to charge a fee for everything and all their time. Liz has over 300 units she has to manage, right? Yeah. So no, that's right. So you said that it is in her contract to visit the property at least once a year.
I think it's exactly. I think it's once every 12 months. Yeah.
Once every 12 months. Okay, perfect. No, that sounds good. It's probably during lease renewal period is when they would do that, would be my guess. But with her, she's generally there a little bit more often than some other property managers who just kind of set it and forget it. So no, that's great. Did you guys have a good conversation with her about how she manages properties and everything?
Yeah, no, it's just was marketed, I think 2 days ago, I think it was. So now we're trying to, the refinance on it right now. So might give the other Liz a call.
Okay. Gotcha. Yeah. Give other Liz a call about refinance and everything. And, your guys' project was super quick. So you might not even reach the 3 months period for seasoning. So is your plan to go DSCR or conventional?
DSCR, yeah.
Okay, perfect. Yeah. So once you have it rented, you could do some of it even before it's rented, but I would get with Liz Lawrence, the lady who spoke tonight, other Liz, and start talking with her over options and everything. And just shoot me a text and I'll give you her contact info as well.
Sounds good.
So sweet. Awesome. Any other questions before we hop off? Sorry for being a little late. Liz had some personal business things to tie up real quick before she jumped on the meeting, but we should all be good now. I hope you guys learned a lot. What kind of final questions do you guys have? Sounds like we're all good then. Well, if anybody wants to talk further, feel free to call me, text me, email me. You probably all know I'm attached to my phone at all times. We can definitely set up a one-on-one call to kind of go over some things, and we'll go from there. But thanks everybody, and I will see you next Tuesday at 8:30.
Awesome. Thanks, Mitch. Have a good one.
No worries. See you, Sean.
Thank you.
Yep.
Thank you so much.
Of course.